Welcome to another webinar brought to you by the Financial Sector Conduct Authority. We are here today to talk to you about the sector risk assessment of the collective investment scheme managers and financial services providers. Now, this is a very important webinar because this is new information that we're going to share with you today. And we would like you to pay close attention because this really is going to help you a lot when you review your risk management and compliance program as an accountable institution. Just as a matter of introduction, my name is Michele Fourie. I work for the Financial Sector Conduct Authority, specifically in the FICA Supervision Department, and I'm joined today by Kgomotso Molefe, who is a specialist, an AML CFT specialist. Kgomotso, say good day to the viewers. So, excellent. So you might wonder, since the FSCA is a market conduct regulator, why would we like to speak to you about money laundering and terror financing and proliferation financing matters? So to clear that up, or just to explain it to you, as much as we are a market conduct regulator, the FSCA is also designated as a supervisory body in terms of Item 1 of Schedule 2 to the Financial Intelligence Center Act. And that means that as a supervisory body, we are responsible for performing supervisory and enforcement activities on a risk-based approach in relation to the accountable institutions under items 4, 5, and 12 of the FICA Act. So not to bore you with jargon, but that essentially means we supervise financial services providers and collective investment scheme managers who are also accountable institutions. In addition, we also supervise authorized users, but we have delegated that supervision to licensed exchanges. Perhaps we need to just step back and start at the beginning. So we would like to take the opportunity to just introduce you also to the Financial Action Task Force. The FATF is an intergovernmental body which sets standards to promote effective implementation of legal and operational measures for combating of money laundering, terror financing, and proliferation financing of weapons of mass destruction. Why is this relevant to our discussion? Well, it's because South Africa became a member of FATF in 2003. And due to this membership, we agreed to uphold and implement the standards set by the FATF as an intergovernmental body. Now, in particular, the FATF developed 40 recommendations, which when implemented, will provide for a robust framework to combat MLTF and PF risks. Now, the FATF conducted a mutual evaluation, which really is an assessment on South Africa in November 2019. So what they came to do was to assess our legal framework. So there was a technical compliance assessment, as well as how effectively we are able to identify and mitigate MLTF and PF risks as a country. They have published a report last year in October, and that report is demonstrating findings as it relates to how well we as South Africa have implemented the 40 recommendations and how effective we are in identifying and mitigating the risk. Now, one of the immediate outcomes that we would like to start off with today is immediate outcome 1 that relates to risk, policy, and coordination. So this is where everything starts in relation to the foundation of the sector risk assessment we would like to talk to you about today. I'm going to hand over to Kgomotso to quickly explain to us what this risk, policy, and coordination immediate outcome is about. Kgomotso.
Thank you, Michele. Immediate outcome 1 addresses policy, coordination, and cooperation to mitigate money laundering and terrorist financing risks. So what is the FATF requirement? It is that ML and TF risks are understood, and where appropriate, actions must be coordinated domestically to combat ML, TF, and PF. So what is the expectation from South Africa? South Africa is expected to properly identify, assess, and understand its ML and TF risks, and also to coordinate domestically and to put in place actions to mitigate these risks.
So Kgomotso, seeing that we're dealing with a sector risk assessment today, can you tell us more about whether the FSCA has conducted this kind of assessment before? Is it just reviewed now? And what is the purpose of a sector risk assessment?
Thank you, Michele. Most certainly. As a matter of background, the FSCA conducted the previous sector risk assessment in 2018, 2019, which results were published on the FSCA's website on the 31st of May, 2019. As good practice, and in order for our SRA to remain relevant, we need to review and update the information and conclusions from time to time. We know that risks evolve and remain stagnant, and do not remain stagnant rather. So the FSCA reviewed and updated its risk assessment for the period of April 2018 to December 2020. The risk assessment was conducted on 3 sectors. The first sector being the securities sector, which covered authorized users of licensed exchanges, as well as over-the-counter derivatives providers, or ODPs for short. It must be noted, however, that ODPs are not classified as accountable institutions in terms of the FICA Act. However, the FSCA thought it important that we also evaluate this particular sector or industry in order to identify, to assess, and understand any ML, TF, and PF risks which may exist. The second sector assessed was the collective investment schemes sector, which covered CIS managers. And lastly, we also assessed the financial advisory and intermediary services sector, which covered certain categories of FSPs. This current sector risk assessment is divided into 2 parts, or 2 reports will be published. The first report relates to the SRA for the securities sector, and the second report relates to the SRA for the CIS and financial advisory and intermediary services sector. However, the specific focus of today's webinar will be on the updated CIS and FSP sector risk assessments. Thank you, Michele. The expectation from supervisors is to identify, assess, and understand ML, TF, and PF risks in the sectors which they regulate or supervise. This in relation to collective investment schemes managers and financial services providers. So the FSCA follows a methodology as recommended by FATF, which evaluates 3 areas. The first area being criminal threats, second area being vulnerabilities or inherent risks, and the third area being consequences. So the SRA can be used as an important tool or resource for feedback on ML, TF, and PF risks in the sectors. The FSCA expects that accountable institutions must consider the risks identified with specific reference to the red flags, the trends, typologies, and vulnerabilities discussed in the report. We also expect accountable institutions to refine compliance controls and their mitigation strategies. to identify and monitor risk factors that may apply to their individual businesses, as well as to assist in reporting suspicious and unusual transactions or AML-CFT related matters to the FSCA and the Financial Intelligence Center.
So Kgomotso, in following this methodology of looking at criminal threats, vulnerabilities being inherent risks and consequences, I'm sure that the FSCA had to gather a lot of data from various sources in order to do this risk assessment. Can you tell us a little bit more about who was consulted?
Most certainly, Michele, it was a very robust and extensive exercise. So in order to collect as much useful information, we cast the net very wide. We requested and received information and data from both internal and external stakeholders. Internally, we requested information from the FSCA's Enforcement Division, and externally, we received information from exchanges, as well from our law enforcement and intelligence agencies, for example, the NPA, SARS, and RUSI. We also had targeted engagements or consultations with industry associations, as well as industry experts. We received some critical information from the Financial Intelligence Center. As part of our data collection exercise, we issued industry surveys specifically to authorized users as well as over-the-counter derivatives providers. And in the case of CIS managers and FSPs, we issued a DPI or a directive to provide information. We also requested information from the South African Reserve Bank, specifically the Financial Surveillance Department.
Sure, that certainly was very wide and broad consultation. So bringing all of this information together now, figuring out what it's telling us, can you tell our audience how did you actually conduct the risk assessment?
Most certainly, Michele. Just to take a step back, as previously indicated, we follow the methodology recommended by FATF, which assesses 1, criminal threats, 2, vulnerabilities or inherent risks, and 3, consequences. So this slide covers the first area of assessment, being criminal threats. What do we mean by criminal threats? Threats refer to criminal threats including MLTF risks that face the industry. So in assessing criminal threats, the following information was considered. We considered information pertaining to materiality or characteristics of the industry. So here we looked at the size of the industry, the role players, the different products and services provided, and other factors. We also considered MLTF PF cases investigated and prosecuted in the sectors. We considered predicate offenses that were investigated and also prosecuted in the sectors. Fourthly, we considered proceeds of crimes that were seized in the sectors. We also considered reporting information submitted by the industry to the Financial Intelligence Center. And lastly, we considered MLTF trends in the industry. So what are some characteristics of the CIS sector? Firstly, a CIS is an investment vehicle that allows investors to pool funds and invest in assets which they may not otherwise be able to access in their individual capacities. Investors are allocated a participatory interest or participatory units in proportion to the value of their contribution to the portfolio. Investors do not have control over these assets purchased with their funds. Instead, they enjoy the benefits of a diversified portfolio. Some interesting information about the sector. Collective investment schemes are regulated in terms of the Collective Investment Schemes Control Act of 2002, for short, CISCA. These schemes are managed by a registered CIS manager or an investment manager authorized under the FAIS Act in terms of a delegated mandate. So what other types of schemes do we have? We have a CIS in securities, CISs in property, CISs in participation bonds, as well as CISs in hedge funds. During the period of assessment for the risk assessment, the number of registered CISs was 65. And last but not least, more of this interesting information is available in the report. The assets under management for the period under review amounted to a staggering 91.61 billion rand. What are the characteristics of the FSP sector? An FSP is any person other than a representative who, as a regular feature of their business, furnishes advice, renders an intermediary service, or provides both in respect of a financial product. Some interesting information. FSPs are regulated in terms of the Financial Advisory and Intermediary Services Act of 2002, short FAIS Act. During the period of assessment, the number of FSPs was 9,179. This excludes the number of authorized FSPs for short-term insurance as well as health. Most FSPs provide advice, they do financial planning and sell products or help clients to select appropriate products for their financial needs. FSPs also do not handle client funds and are not allowed to use discretion on behalf of clients. And lastly, but not least, more information is available in the report. The assets under management for the period of assessment amounted to a staggering 10.175 trillion rand.
Sure, Kgomotso. Now that we have a much better understanding of the regulatory landscape of these sectors, I'm sure the viewers are very curious to know what your findings were.
Absolutely, Michele. Our findings were indeed curious, but interesting. We noted that there were no MLTF cases investigated or prosecuted involving CIS managers and FSPs. Some of the information provided indicated that during the period of June 2022 to March 2021, the NPA prosecuted 45 matters involving ML. In most of the matters, being 42%, the predicate offense is indicated as fraud. From a predicate offense perspective, the main concerns in these sectors related to fraudulent claims, Ponzi schemes, and unauthorized or unlicensed businesses. And the most common offenses reported to the Financial Intelligence Center in relation to CIS managers related to fraud and forgery, and in the case of FSPs, related to fraud and tax evasion. Thank you, Michele. The FSCA referred 104 matters to the SAPS to investigate. Some of the critical information and statistics that we gathered were generated from the Directive to Provide Information, being the DPI. And we observed the following: that 2% of CIS managers have been subject to investigation by SAPS, and that 0.25% in the case of FSPs. We noted that 0.9% of FSPs indicated that they were defrauded by clients, and that 1.04% reported a glitch, reported that their businesses was defrauded by employees. We noted that CIS managers, 6% thereof, indicated that their business was defrauded by a client. However, there were no accounts reported of CIS managers' employees defrauding their businesses. We also noted that 2% of CIS managers reported that their business was approached with a corrupt deal, and 0.46% in relation to FSPs. We noted that 360 STRs were submitted by CIS managers to the FICA, and this was to the value of 182 million. We also noted that FSPs submitted 10,553 STRs to the Financial Intelligence Center, and these to the value of 3,450 million rand. During our assessment, we also noted some ML techniques which may be used in the case of CIS managers, and these are but some of the identified techniques. The rest are detailed in the report. In the case of CIS managers, we noted that clients could be paying a large sum of money into a CIS product and then disinvesting the money from the product by requesting the money to be paid to fictitious beneficiaries. Clients may also make payments for participatory interest via third parties. Another technique is a change of beneficiaries of a trust, which cannot be satisfactorily explained. We also noted that there could be anonymous clients or clients with false or fictitious names. In the case of FSPs, clients could purchase a product which is not consistent with the customer's need, or there could be a purchase or funding of a product that appears to exceed a customer's known income or liquid net worth. Some clients could demonstrate or show a great concern about early termination features. And lastly, but not least, there could be a change of beneficiaries, which too cannot be satisfactorily explained.
So these are certainly, Kgomotso, some red flags. And it's one of the reasons we are imploring the viewers to really go and have a look at this report, because we're touching on a high level today, but I'm sure there's much more in this report as it relates to the regulatory landscape and the threat analysis. But with regards then to having handled the threat analysis, you mentioned that we're also going to deal with vulnerabilities, being the inherent risks, which is quite a buzzword, and I'm sure you have a lot of information to share with the viewers about vulnerabilities.
Yes, most certainly, Michele, I do. So what do we mean by vulnerabilities or inherent risks? These refer to the features and characteristics of the industry that make it attractive for MLTF purposes. Information in relation to the following risk indicators was collected from the various information sources. We collected information pertaining, 1, to clients, and here we looked at the nature and types of clients. Are they natural persons? Are they legal persons? Are they foreign persons? And other factors. Number 2, we considered products and services. Number 3, we considered distribution channels. Number 4, we considered geographies or geographic locations. Number 5, we considered the use of cash. And lastly, number 6, we considered the mitigation of MLTF and PF. In relation to the first risk indicator being clients, the results of the DPI indicated the following: that 78% of CIS managers had a client base which consisted of a majority of natural persons, and 57% in respect of FSP's clients. We observed that 56% of CIS managers had a client base including a majority of legal persons, with only 14% reporting that trusts make up a majority of their clients. In the case of FSPs, 19% indicated that they had legal persons comprising the majority of their clients, and 7.93% in respect of trusts making up a majority of the client base. And the last point on this slide is that 2% of CIS managers had partnerships as a majority of their client base, and 5.52% in the case of FSP's clients. We still have some interesting information to share on clients. The DPI also indicated that 2% of CIS managers described that the majority type of their clients is foreign-based, and 2.21% of FSPs rendered financial services to a client base that comprises of a majority of foreign-based client. In the case of FSP, 0.24% indicated that FPPOs form a majority of their client, and 0.84% in respect of DPIPs as a majority of the client base. FPPOs and DPIPs refer to those politically influential persons. Then the last point on the slide is that 4% of CIS managers reported that they have DPIPs as a majority of clients in respect of whom financial services are rendered, and that 2% indicated that FPPOs comprise a majority of their client base. In relation to the second risk indicator, being products and services, here the DPI results indicated the following: that a large proportion of CIS managers, being 70%, rendered financial services in respects of products with offshore exposure. We also observed that 28.5% of FSPs rendered services in respect of products with offshore exposure themselves. So CIS managers render quite a significant percentage of services in respect of offshore exposure as compared to FSPs. We noted that 2% of CIS managers and 0.63% of FSPs rendered financial services in respect of products with crypto asset exposure. So here the stats are very low, indicating that it's not quite prevalent for financial services to be rendered in respect of crypto assets or products with crypto assets exposure. We observed that 4.35% of FSPs and 12% of CIS managers provide financial services in respect of unlisted securities. We found that none of the CIS managers render services in respect of Forex products. This compared to 2.71% of FSP rendering financial services in respect of Forex. The result pertaining to CIS managers is attributable to the regulations which were issued in terms of CISCA. And then the last bullet point is that 2% of CIS managers and 4.11% of FSPs render financial services in respect of private equity. On to the third risk indicator, being distribution channels. And these were the results of the DPI. We observed that 7.41% of FSPs engaged with third parties, and 40% of CIS managers indicated that they had entered into engagements with persons acting on behalf of clients. We also noted that 6% of CIS managers and 2.91% of FSPs engage with clients through juristic representatives. We observed that 18% of CIS managers described that a majority type of engagements with clients is face-to-face, and 56.15% in the case of FSPs. CIS managers, 38% thereof, and FSPs, 43.93% thereof, indicated a majority of their engagements with clients as being telephonic. We found that CIS managers, 82% thereof, made use of electronic engagements with clients as a main channel of distribution, and that 44.88% in the case of FSPs. And lastly, on the slide, we observed that 2% of CIS managers engaged with clients via mobile applications and 4.82% in respect of FSPs as a major distribution channel. On to geographies or geographic locations. The DPI results indicated that none of the CIS managers had clients that appeared on the UN sanction list. However, 0.46% of FSPs had clients that have appeared on the UN sanction list. We noted that most CIS managers and FSPs are domiciled or operate in South Africa. 2% of CIS managers indicated that they operated in foreign jurisdictions, whereas 1.42% in relation to FSPs. We identified or found that most transactions in the CIS sector are located in the Western Cape, and most in the financial advisory and intermediary services sector are located in Gauteng. This is, however, not unusual, as Gauteng and the Western Cape are financial hubs in South Africa. And lastly, from an international perspective, transactions in the financial advisory and intermediary service sector originating from China were the most reported by FSPs. On to use of cash as a risk indicator. We found that CIS managers submitted 2,030 CTRs or cash threshold reports to the Financial Intelligence Center, and these were to the value of 125 million rand. FSPs submitted 38,900 CTRs to the value of 4 billion rand. We noted that the use of cash is still prevalent in these sectors. Then on to the last risk indicator, being mitigation of MLTF risk. The results of the DPI indicated the following: that CIS managers had conducted MLTF risk assessment to identify MLTF risks faced by their businesses. And in this case, it was 100% of all the CIS managers that provided information in respect to the directive. And only 3.06% of FSPs had not conducted MLTF risk assessments to identify risks faced by the accountable institution. The results also pointed to 98% of CIS managers have an RMC providing for client identification and verification of beneficial owners. We noted that 1.51% of FSPs have not developed an RMCP, and that 1.38% do not take appropriate steps as set out in the RMCP to identify beneficial owners. And lastly, a total of 2% of CIS managers indicated that they do not conduct CDD in line with the RMCP. However, most, being 98%, do establish and verify the identity of a client on a risk-based approach. We found that 1.2% of FSPs indicated that they do not conduct CDD in line with their RMCPs, and that 1.15% do not establish and verify the identity of clients on a risk-based approach to establish the type and extent of CDD that must be conducted. We also noted that 96% of CIS managers have updated their registration details on the FICA Go AML portal, and that 2.51% of FSPs indicated that they have not updated their details. Now on to consequences as the last area assessed in terms of the FATF methodology. In the context of the risk assessment, consequences refers to the impact or harm that MLTF risks may cause or have on A, clients, B, financial institutions, C, the financial sector as a whole, and D, the broader South African economy. These are some of the consequences that have been identified that could impact or harm clients, financial institutions, the financial sector, and the broader South African economy. In the case of clients, clients could have a loss of confidence in the financial sector, and clients themselves in their own capacities could experience financial losses as a result of MLTF risks. In the case of financial institutions, institutions could suffer financial losses due to criminal abuse of their businesses. They could also suffer reputational damage and in turn lose clients. The FSCA could also impose administrative sanctions on financial institutions that do not comply with the FICA Act. Financial institutions could also be subjected to criminal prosecutions. In the case of the financial sector, the biggest impact or harm is reputational damage, and this could lead to the reduction of investments. Then lastly, in the case of the South African economy, the economy could become distorted and become unstable. We could experience reduced revenue or GDP. This could affect our savings and investment, and South Africa could possibly end up being blacklisted or ending up on the grey list of FATF.
Sure, Kgomotso. So it's very clear from what you've been explaining today that it's so important to be able to understand your MLTF BF risk, to assess it, being mindful of the threats and the vulnerabilities, and then mitigate it. Because if we don't, then these very bad consequences could certainly materialize. So considering everything you've explained through the assessment of the threats and the vulnerabilities and the consequences, what was the overall rating?
Thank you for the question, Michele. So, having taken into account the different risk indicators, different risk factors, and also allocating weightings, each sector was assessed as low, medium, or high risk in each area evaluated, namely criminal threats, vulnerabilities or inherent risks, and consequences. All three risk areas were combined to give a holistic rating of the CIS and FSP sector. We came to the conclusion that CIS managers as well as FSPs are assessed as medium risk for money laundering, terrorist financing, and proliferation financing.
Okay. So it's also clear, I think, if I recall from the first sector risk assessment conducted, that the outcomes of the overall risk rating has changed with the review of the sector risk assessment, just again demonstrating your earlier point, Kgomotso, that risk isn't stagnant. It evolves, it changes, circumstances changes, threats and vulnerabilities change. So that's why it's clearly, evidently important to do these reviews, publish it for the benefit of the accountable institutions in this sector. Now, I'm sure the viewers are very eager to know where and how can they get their hands on the CIS Manager Financial Services Providers Sector Risk Assessment Report. Now, this we have published on the official website of the FSCA. You can go to www.fsca.co.za. Scroll down to the grey banner at the bottom of the screen. Bottom right, you'll see a heading that says Regulatory Framework. Click on that heading, then scroll down to the block or tab for AML-CFT, where you will find the sector risk assessments done and published there. And the one we specifically discussed today, as I mentioned, is the sector risk assessment for collective investment schemes and financial services provider sector. We have a variety of information published under the AML-CFT tab for your benefit as the viewer, as an accountable institution supervised by the FSCA. So we really encourage you to visit the website, tell your colleagues about the webinars that are published on the FSCA's YouTube channel. It can only add value. It can only help you to understand your risk better and probably to then mitigate it better. If you need to contact us, our contact details are also on our website, but I'm displaying it also on the screen for you. And then perhaps in closing, Kgomotso started with the presentation dealing with what the FSCA's expectations are. And I would like to just remind you that we do expect the accountable institutions to comply with preventative measures. And in FATF language, those preventative measures in terms of immediate outcome 4 relates, amongst others, to understanding your MLTF risk. You are obligated to review your risk management and compliance program. And when you do that, please go to the website, go read the sector risk assessment, apply your mind to the red flags. It will really just enhance your understanding of the prevalent risks. So if you're struggling, like I say, we have tools and information available on our website. We are also intending to issue communication to all our accountable institutions this month, where we want to give you an information pack that's going to blow your socks off with links to documents, guidance, webinars to really assist you when you have to review your RMCP, to do a good job, do it intensively, and get to accurate outcomes so that you understand your risks well. I would like to thank you very much for your time, and Kgomotso, again, a privilege to have a webinar with you presenting, and I hope you all have a wonderful day. Thank you. Bye-bye.